for joining us for our third quarter earnings conference call. Today, I'll briefly walk through our results for the quarter, and then I'll discuss significant progress that we've made since our last earnings call. In the third quarter, we generated revenue of $1.8 million. Our GAAP net loss was $58 million in the third quarter, which includes one-time costs related to our IPO, compared to a loss of $30.6 million in the second quarter of 2021. We ended the quarter with $125 million in cash equivalents, and investments. Mahesh will provide more detail on our financial results later in the call. Now I'd like to talk about our business. In August, we completed our business combination with SC Health and began trading on the New York Stock Exchange. Through the process, we raised $168 million, which will help us to develop our consumer wearables solution while we work towards its commercialization. We not only strengthened our balance sheet, we also gained increased stature with some of the largest companies in both consumer wearables and medtech. I believe that becoming a public company has already helped accelerate the commercial opportunity for our vital spec biomarker sensing platform. For those unfamiliar with it, the Rockley vital spec sensing platform is an end-to-end solution that combines photonic-based hardware, optimized biomarker algorithms, and cloud-based analytics and AI. It enables clinical and healthcare research practitioners to integrate more comprehensive, non-invasive biomarker measurements in their remote patient monitoring studies. Rockley's proprietary silicon photonics-based laser technology significantly expands the range of biomarkers that can be detected and measured continually and non-invasively beyond the capabilities of current LED-based sensors. This expanded range includes key biomarkers like core body temperature, blood pressure, body hydration, alcohol, lactate, and glucose trends, amongst others. These new measurement capabilities have the potential to transform digital healthcare by providing real-time insight about a variety of health conditions and enabling early detection of multiple disease states. Turning to our product strategy, I am very pleased with the progress that we have made during the quarter in providing our partners with unique solutions which will power their health and wellness products. Today, we announced new partnerships with 5 global consumer electronics companies, including 4 of the top 10 wrist-based wearable companies, strengthening our position in the market by adding some of the most prominent companies in the smartphone and wearables market. 6 of the world's top 10 manufacturers of smartwatches and wristbands now look to our platform as an important part of their health and wellness strategies. In medtech, we recently signed partnerships with 2 of the world's largest medical device companies. Working with these companies has expanded our development effort for our wearables and end-to-end data analytics solutions. And finally, I'm very excited about our partnership with the California Institute of Technology, or Caltech, because I believe that this program will both add to the development of our VitalSpec platform and will give this partner unique tools that will help them advance the tremendous research that they undertake. Now I'll start with an update on our consumer solutions and some of our key partnerships. As a reminder, in this market, we develop chipsets and modules for large consumer electronics companies who will use our solutions in wearables and handheld devices for the consumer health and wellness markets. Because of our unique non-invasive biomarker sensing technology, demand for these products is increasing as our partners work to create innovative products that can help them improve the health and well-being of their customers. We have long-standing relationships with several leaders in the consumer electronics space, and we've added the 5 new partners I discussed a moment ago. We believe that working with these companies will increase our ability to successfully launch our clinic on a wrist solution in the health and wellness market and will reduce our reliance on any one partner. Next, I'll discuss the medical device market. In this market, companies are focused on improving patients' lives through innovative solutions, and they pursue partnerships with companies that can help them achieve their goals. During the quarter, we announced that we signed multi-year partnerships with 2 of the world's top 10 medical equipment and device manufacturers. We will work with these industry leaders to evaluate and incorporate our next generation of non-invasive biomarker sensing technology into their products, providing them with a complete end-to-end biomarker sensing platform that combines photonics-based hardware, optimized biomarker algorithms, and cloud-based analytics and AI. We also believe that these partnerships will accelerate our product development and timelines and will help us identify and advance potential use cases for our technology in mobile devices for remote patient monitoring. I'm also very pleased about our partnership with Caltech. Through this partnership, we hope to add to the development of future healthcare applications that will use our sensing platform. As part of the agreement, we will collaborate on the development of next-generation solutions that combine advanced sensors with artificial intelligence to enhance insight into health and well-being. Combining sensing and algorithm research, Caltech's Sensing to Intelligence initiative is developing more efficient and intelligent sensing systems that align with Rockley's approach to health and wellness monitoring, combining photonics-based sensor technology with state-of-the-art artificial intelligence and data analytics into an end-to-end platform. This partnership intends to focus on a range of projects, including the development of new spectrometer technologies using advanced photonic sensors, which will help us broaden and enhance the health monitoring capabilities of Rockley's platform. The team also intends to explore new applications for cloud-based services and will look to exploit the advanced capabilities of platforms such as Amazon Web Services to advance healthcare innovation. I also want to update on our ongoing human studies. We have made very good progress with these studies, and we plan to announce the results of our first study next month, with others to follow in 2022. Following the tape-out and fab-out of our pre-alpha samples of our product, our studies currently utilize these devices in our non-invasive biomarker sensing bands and optimize biomarker algorithms to gather information from our study participants, which then upload to the cloud. As we develop this library of diagnostic knowledge, we will use artificial intelligence and analysis to create the foundation that will provide deeper understanding of human health and wellness. We believe our alpha devices are on track and will be utilized in our human studies and available to our partners for their pre-production studies in 2022. Finally, I'd like to take a moment to thank our team for their hard work across all aspects of our full-stack solution. The biomarker human studies require a great deal of effort, and the entire Rockley team and our volunteers have really stepped up to the task as well. Thank you. All these initiatives create significant opportunity for Rockley and enable us to pursue multiple avenues in parallel. I'm very pleased with the response that we've had from all the markets that we serve and believe that each has the potential to allow us to achieve our goals. Our consumer electronic partnerships are going well, and with the additional partnerships that we have announced, we are now working with the leaders in the consumer, smartphone, and wearables markets. I am delighted with the response from our current medtech partners, as well as the many other companies who have recently expressed interest in working with Rockley. I believe that these medtech partners understand the importance of the work that we are doing, not only to identify individual biomarkers, but also to interpret the data using cloud analytics and AI, so that we can provide them with actionable information. Based on the progress that we've made and the response from our markets, I'm very excited about the prospects for our company. We will continue to develop our innovative full-stack, non-invasive silicon photonics-based solutions, and we are optimistic that the work we are doing today will change the world and will transform digital health, wellness, and healthcare with actionable insights powered by Rockley. With that, I will turn the call over to Mahesh for detailed review of our financial performance in the quarter. Thank you.
Thank you, Andrew, and good afternoon, everyone. I will begin by reviewing our third quarter performance, and then I will provide an update on our outlook for the fourth quarter. Turning to our third quarter results, we reported revenue of $1.8 million compared to revenue of $2.2 million in the second quarter. As a reminder, we are in the pre-alpha stage of developing what we believe to be a game-changing technology for the broad health and wellness sector, as well as medical device companies that could benefit from our leading technologies. As such, our current revenue is derived from non-recurring engineering activities, which results in quarter-to-quarter variability. Our third quarter cost of revenue was $3.5 million, compared to $4.5 million in the second quarter of 2021. Our non-GAAP cost of revenue was $3.1 million, compared to $4.2 million in Q2 of 2021. As we previously mentioned, our cost of revenue can fluctuate from period to period depending on several factors, including the timing of the completion of project milestones. Moving to operating expenses, we recorded total GAAP operating expenses of $40 million in the third quarter, compared to $24.3 million in the prior quarter. GAAP SG&A expenses was $13.6 million, compared to $6.7 million in Q2 2021. And GAAP R&D expenses were $26.4 million versus $17.6 million in Q2 2021. The increase in expenses was driven primarily by $14.3 million in one-time transaction-related costs, personnel expenses, and public company costs. Total non-GAAP operating expenses for the third quarter was $33.7 million compared to $21.5 million during the second quarter of 2021. Non-GAAP SG&A expenses was $9.4 million compared to $5.8 million in Q2 2021. Non-GAAP R&D expenses totaled $24.3 million in Q3 versus $15.7 million in Q2. We plan to continue to expand our R&D organization as we drive our technology forward to support the many growth opportunities ahead of us. Our R&D efforts are essential to our ability to remain on track for our customers' projected product rollouts. As we scale the business, we expect our expenses to fluctuate as a percentage of revenue period to period, but to generally decrease over the long term. Moving to net income, we recorded a GAAP net loss of $58 million, or a loss of 54 cents per share in the third quarter, compared to a net loss of $30.6 million, or a loss of 36 cents per basic share in Q2 2021. Our non-GAAP net loss was $51.4 million, or a loss of 48 cents per share in the third quarter. Adjusted EBITDA, a non-GAAP measure, was a loss of $35.6 million in the third quarter, which compared to the loss of $23.4 million in the second quarter of 2021. Our net cash used in operating activity totaled $37.4 million in Q3, compared to $29.6 million in Q2. The sequential increase was primarily driven by an increase in headcount and R&D activities. Turning to our balance sheet, we ended the quarter with cash equivalents, and investments of $125 million, an increase from $35.4 million on June 30th, 2021, prior to the close of our transaction. During the quarter, we retired all our convertible notes, and we expect to retire our remaining debt obligations of $28.6 million in 2022. Recently, we announced that we signed a financing agreement with Lincoln Park Capital to provide us with an equity line of credit of up to $50 million. This agreement will strengthen our balance sheet and provide us with additional flexibility as we work to commercialize our non-invasive biomarker sensing solutions. Looking ahead, as we previously discussed, we continue to believe that we will generate approximately $27.5 million in revenue in 2021. This guidance includes a significant technical sale in the fourth quarter, and as with similar deals, there is always the chance that the transaction will slip into 2022. In wrapping up my prepared remarks, we are pleased with our performance in the third quarter. We significantly strengthened our balance sheet through the completion of our business transaction with FE Health in August, and we believe we remain well positioned to execute on our roadmap ahead. I will now turn the call back to the operator to open up the call for questions.
Thank you. If you would like to ask a question, please press star one on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star two if you would like to remove your question from the queue. And for participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. Our first question is from Vivek Arora with Bank of America. Please proceed.
Thanks for taking my question. So Andrew, for the first one, you mentioned the addition of new consumer electronics partners. I was hoping you could give us a little more color. What does that do to the size of the opportunity? When do they start adding to the backlog? When do they start becoming more important to your expectations? And then are they engaging with you exclusively, or are you part of other engagements that they're also doing?
Great question, Vivek. Thank you. So obviously in our set of projections, we had 4 consumer customers, and now we have 6 of the top 10 wearables customers, and obviously additional customers as well. So what that says is that you can look at the numbers and say, okay, this is either an increase to the opportunity or it's significantly de-risking the opportunity for us with this significant increase in the number of signed customers and our penetration into the vast majority of the available addressable market in wearables. That's the first thing. Second thing is that what we do with these customers is, when they're signed up, is we start work with them on the physical design-in activities, and that is what we're doing with all of these customers. So what then translates into next year is the process of providing a significant number of units for their qualification process, following the detailed design-in work that we're doing with them now, which then prepares them for the launch of their products into the consumer market in 2023. So no change there from the plan, just significantly more customers than were in the projections, and whichever way you like to look at it, significantly de-risking what we say we're going to do.
Got it. And Andrew, on the medtech opportunity, what is the most important product milestone that you need to deliver on to make that happen?
So on the medtech area, it's the same technology, it's the same module technology. But what's really exciting is when we took the company public, we really focused attention on the consumer area, which is now obviously rocketed ahead in terms of our engagement with customers. But we weren't explicit about what we were doing in the medtech area, other than that we had customer engagement. It's now clear from our continued development and our continued development of the commercial opportunity and the customers that we're working with, which amongst others include two of the world's leading medical device companies, is that these customers all want us to deliver a full stack solution into particularly things like patient remote monitoring. And so what's involved in that is basically everything that we have been developing, all the way from the modules going into the wearables, into wearables suitable for the healthcare market as opposed to the consumer market. And there's a difference there. And then the algorithms for the individual biomarkers, and then the algorithms in the cloud that process the information longitudinally over time to come up with guidance and insight and diagnosis for patients. So all of that is accelerating very, very rapidly for us. And as we said, it essentially creates another further growth opportunity for us. But what's really different about it is, well, actually there's not a great deal of difference in terms of what we do. It's really more about customers engaging in the healthcare area for our entire full stack capability, and the need for us to present the solution in a format that's appropriate for the healthcare market as opposed to the consumer market. And that is a sort of physical implementation into wearable devices that are quite unobtrusive, don't do any other functions other than focus on an individual's health, and sit there in the background continually monitoring the patient and providing the data into the cloud, into our cloud platform, which we then interface to our customer.
And maybe one or two for Mahesh, if I may. On the backlog, you mentioned 23 million, if I got that right, I think steady from Q2 to Q3. That still leaves a fair bit of turns business that you will need to execute on for next year. I'm curious, how's your level of visibility and confidence around the next handful of quarters versus what you had 90 days ago?
Okay, let's break it into two pieces. For 2021, we have guided 27.5 million. This includes a significant technical sale, and as with similar deals, there is always a chance that the transaction will slip into 2022. For the 2022 guidelines, at this stage, we feel comfortable, and if there is any other change, we will let you know appropriately.
Thank you, Mahesh. And just the last one, how are you positioned from a financing perspective, and how should we think about just the use of cash over the next several quarters as you execute to your 2022 plan? Thank you.
As we had said in our last call, we believe we have raised enough funds to take our customer wearable products to commercialization. To supplement other activities, we announced today that we entered into a financial agreement with Lincoln Park Capital, where they will provide us with the option to utilize up to $50 million through an equity line of credit or ELOC.
Thank you.
Our next question is from Quinn Bolton with Needham & Company. Please proceed.
And just wanted to follow up on Vivek's questions. First, on the new consumer electronics customers, I just want to make sure I have this right. I think at the time of the business combination, you had talked about 4 consumer electronics companies, leading to your forecast. Am I right to think now with the 5 additional, you're at 9, or did the 5 customers that you talked about on this call include some of those original 4?
Hi, Quinn. Yeah, good question. Yeah, for clarity there, if you recall that we were signed or engaged with those customers. I didn't mean to say that we had signed them all. What we are now saying that we have signed 6 out of the top 10.
Got it. Okay, thank you. And then some following questions to the CE customers. Do any of them generate NRE opportunity for you in 2022 or into 2023 as they look to go to production? And second, do any of them require customization that might lead to additional OpEx outside of the original plan that you had put forth?
Yeah, Quinn, this is Mahesh. On that subject, currently our focus is to develop a standalone product which we will be able to come to the market. So NRE from this customers is not our focal point. However, there will be some NREs, but I would not expect it to be very material.
Got it. Okay, great. And then it sounds like the outlook for the company to deliver the pre-alpha samples to customers next year so they can conduct their human trials remains on track. So it sort of sounds like those first customer devices likely announced either late 2022, early 2023 with the production ramp in 2023. No change to that timing.
Yeah, that's correct, Quinn. And just to clarify a couple of things, the pre-alpha devices exist today, and we have been providing devices to customers that we were due to tape out and fab out our alpha versions. We've done that now. We've got the first lots come back as expected, and then those alphas will be supplied to customers starting in the first half of next year as part of their ongoing evaluation, if you like, and pre-production activities. Then by the middle of next year, the full production version with a few tweaks, which are inevitable, will have been taped out and fabbed out by us, and then that will start ramping in Q4. And at that point, we are basically in the design-in cycle for the products launching in 2023.
Understood. Thank you, Andrew. And then I guess, Mahesh, just sort of on the use of cash, maybe help, just bridge for investors. You've got $125 million of cash today. You burned or consumed $37 million in the third quarter. I don't know if you can give us any comments on what you think cash burn or OpEx might look like over the next few quarters, but if you're starting with 125 and you intend to pay back the $28.6 million of existing debt obligations, it looks like you've got about $100 million of cash outside of that debt repayment to fund operations, and obviously your cash burn in the third quarter was pretty high. So how should we be thinking about OpEx on a quarterly basis over the next few quarters? Does that come down meaningfully? Does revenue ramp pretty meaningfully to offset that? Just any help you could provide would be much appreciated.
On that front, if you recall, we had provided the guidance for this quarter and for rest of the year. As of date, we still feel that the OpEx will be in line with that forecast. So there are a couple of things we are doing to address some of the cash issues. One is this HELOC, which has come in effective today. So that will be a $50 million amount, which we will raise. And then there are other forms of instruments we are looking at, and we will probably address that in Q1 timeframe.
Understood. Thank you very much.
As a reminder, to star one on your telephone keypad if you would like to ask a question. Our next question is from Tristan Gerra with Baird. Please proceed.
Hi, good afternoon. Just following up on the new design wins relative to the alpha sampling. How much of those wins are contingent on basically your company meeting the thresholds that are expected by customers? And you've also said during the Q&A that of the original 4 design wins, some were signed, others were just engagements. So how much of that is really a hard win that is going to launch as long as you deliver the product versus others that might be engagements with a potential or a strong potential to turn into a design win? And then finally, are you able to quantify kind of the design win